What if I told you that just hours ago that the Dallas Fed dropped a bombshell report revealing that Texas manufacturing is now in a death spiral? They're saying business is very slow with no uptick in sight. Recession risks are skyrocketing, and that means bankruptcies are looming. And this is unfolding even as Wall Street smashes record highs. The Fed set to cut rates on Wednesday, and it appears that a U.S.-China trade deal is now locked in stone. But this isn't a far-off threat because it's hitting factories, suppliers, and workers right now. And we're seeing demand softening, and with that, hours getting slashed. But here's a perspective shift. Rate cuts and trade deals, they're not going to reverse this trend. This isn't just bad luck. It's a K-shaped economy, my friends, where more Americans are falling behind as prices rise and hours fall, just as I've been warning all along. Now stick around because I'm going to show you how this report changes everything and how to shield yourself before it spreads. Plus, tonight's show is brought to you by Oncolytics Biotech. You can find them on the NASDAQ and symbol ONCY. And they're a pioneering company developing groundbreaking cancer therapies to help the immune system fight hard-to-treat tumors. And if you're an Elliott Wave trader, the stock is now holding its 6-month volume profile and is about to launch into Wave 5. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, forget the market euphoria, and I know it's hard to, because right now in Texas, manufacturers are signaling real pain that could ripple nationwide, with factories facing complete shutdowns, delayed projects, and even worse, a wave of pessimism. Now let's take a look at the details from the October report, because the production index, now this is a key measure of manufacturing conditions, was unchanged at 5.2, indicating below average output growth for the second consecutive month. Now remember that second half rebound? It's not happening in Texas. And this isn't something you'd expect to see with stocks at all-time highs. But with credit markets cracking and more consumers falling behind due to inflation, this is exactly what you start to see. Check this out. New orders contracting at minus 1.7. Capacity utilization now contracting to minus 1.1 from 3.9. And these are massive red flags for the job market, because what we're facing here is too much supply. That's why new orders are dropping. We don't have enough buyers. At the same time, we're seeing disinflation start to build into the system, and what that means is there's a lot more layoffs ahead. Now, evidence of that, we saw employment rose. This is a good number, plus 2.0. But check out the offset. Hours worked contracted at minus 5.5 from 4.5. So what you're seeing here is just as companies started to get optimistic that things were going to turn around, they hired a little bit, something changed in a major way in Texas. Producers are getting hammered at the edges as prices and wage pressures are now easing. We see raw materials dropping down to 33.4 from 43.4. Wages, here's the big one, down to 14.2 from 15.9. So we continue to see evidence that producers are being squeezed at the margin, and this is why they're cutting hours. The issue we're facing, we have too much inventory in the system, not enough demand, and this is a strong indication that disinflation could spiral into all-out deflation. So what we're seeing in Texas now is uncertainty is skyrocketing. The outlook uncertainty index jumped to 22.2 from 13.9. And get this, future expectations like production down to 21 from 31.6. So as manufacturers look out in the future, they're seeing less to be optimistic about. Now, if you're in manufacturing, energy, trucking, or any supply chain role, this hits right at home just in time for the holidays, because what it's doing is threatening your job security, it's threatening your income stability, and it's threatening your savings. And all this does is line up perfectly with last week's University of Michigan Consumer Sentiment Survey. As we talked about, it showed that Americans have been increasingly worried about the economy, and for good reason, because now you're starting to see in the real data what consumers have been warning about is actually happening. Now let's dive in deeper why this disconnect spells complete trouble, not just for the Texas economy, but for the entire nation. Now here's why this matters, because declines in manufacturing often lead to recessions. In Texas, they represent about 8.5% of U.S. GDP between its energy and factory sectors. In fact, it's a critical bellwether that if they go down, could drag the entire nation right along with them. And that's why the bankruptcy of Tricolor and First Brands that we talked about were not one-off events, as Wall Street wants you to believe, but an actual warning sign. Now, I want to show you that chart setup for our sponsor today show, Oncolytics Biotech. Again, you can find them on the NASDAQ, symbol ONCY, and here's why you do. Particularly if you're an Elliott wave trader, check this out. You have wave 1, a pullback into wave 2. There's your third wave, pullback into wave 4 with support right at a 6-month volume profile, and this is setting up for a monster move higher. Now, again, everything you need to know in the pinned comment and description below. Stay tuned to the end of the show for more information. And here's the evidence, because Morgan Stanley reported that subprime delinquencies are rising across all loan characteristics. So what you see is as hours worked go down, consumers cannot afford to pay their bills. You see delinquencies rising here. So what we're seeing in Texas right now, this isn't a regional issue, but it's starting to become a national issue that we're likely to see as more regional Fed surveys come out. And this is part of the reason why 30% of Americans say they can't even afford to go on a vacation. Because as we've been talking about, the economy for many lower income and middle income families is not working for them. And that's why we're seeing in the surveys that holiday spending is projected to drop 3 to 5%. I think it could be even worse than that. And this is why truckload companies are warning as well, because they're saying capacities are falling. And this hit an all-time low for the month of October. And this places the index at roughly 19% lower than last year, 15% lower than 2023. So you think about it, there's a decline in demand here. What does that mean for the trucking industry and jobs? It means they're going away. Hours are also going to get cut here. And we're even seeing pessimistic comments from producers. Let's take a look at the survey, because they're saying we're considering closing our company at the end of the year and filing for bankruptcy. We just had a huge drop in sales. We've gotten very slow, but soon, if things don't change, there will need to be some significant reduction in hours worked on the plant floor. So let's take a look at some charts, because I want you to see just how close we are to recession, because Texas, they're on the forefront of this, and by fear, if they go down, they take the rest of the country with them. Let's start out with manufacturers' orders of durable goods. That's shown in blue against average weekly hours of production and non-supervisory employees. And what you can see very clearly, as manufacturing production goes down, it pulls the rest of the economy with it. Hours worked, again, we're talking about factory floors here, they go down in red. And so what Texas is warning us in this survey is that manufacturing production and demand and new orders are going to enter contraction, pulled the nation right down with them, and hours are going to go. Let's now turn to capacity utilization against average weekly hours of production and non-supervisory employees, still shown in red. And what do you see? A very clear indication. As a percentage of a factory's utilization declined, so too does the need for employees. Again, here's the risk, as Texas saying, look, capacity demand is dropping as orders go down, and again, hours soon to follow. But we've been hearing this from consumers because they've been warning repeatedly. That's exactly what we saw in Friday's University of Michigan Consumer Sentiment Survey, now shown in blue, because what happens as hours start to go down and workers see that there isn't a lot of new orders, there aren't hardly any backlogs left, and export orders are falling, their sentiment drops, and next thing you know, hours go right along with it. And right now, when you look at where the survey is going, it tells us there's going to be a huge drop in hours right before the holiday season. So here's the bottom line, my friends. Continued manufacturing weakness spills over into trucking, leading to fewer hours and declining savings. And this is a major risk because it's not just Texas. So you think as demand drops, the spillover hits retail and the services sector, then the credit markets that are already starting to crack, well, they break in half, and then the stock market goes right along with it. And that's why the Dallas Fed bombshell pops the market euphoria, because right now, even though we're looking ahead to a 25 basis point cut by the Fed on Wednesday and a China trade deal potentially on Thursday, all this does is buys a precious amount of time, but it doesn't change the trajectory. Because easing rates and tariffs, they're a short-term fix. But without solving the demand slumps and bifurcation, we're now down to one shock from recession territory. When you look at the credit markets, it doesn't seem that far off. Now, hopefully this stays contained regionally, but the risk is that we're going to see it blow out from Texas. Now, tomorrow, we get the ISM manufacturing PMI data. Experts say that it needs a major trigger to cascade. But here's what I want you to do. Look at those new orders books. Look at the backlogs and keep a track on those hours worked. If you want to know the truth, that's exactly where you're going to see it. Now, you can shield yourself now. What do I want you to do? Build that 6-month emergency fund if you haven't done it. Try to diversify your skills beyond manufacturing if that's where you're counting on your paycheck from. Pick up a side hustle, cut your high interest debt, avoid big purchases, particularly as we go into the holiday season. And I know it's tempting as deflation takes steam here. And for investors, rotate into defensive plays. Now, I know this is hard to do with markets at all-time highs and roaring higher, but profit taking, my friends, is never a bad call. And something I think is going to be a big call, that is the stock for our sponsor for today's show, Oncolytics Biotech. Again, you can find them on the NASDAQ and symbol ONCY. And right now, if you're an Elliott Wave trader, they just pulled back into Wave 4 and now sitting on a 6-month volume profile is setting up for a big move higher. You're not going to believe this chart, but let's jump right in because everything you need to know in the pinned comment and description below. Because Oncolytics Biotech is developing a PaleoRep, an innovative cancer therapy delivered by IV. This treatment helps the immune system target cancer cells, showing promise in pancreatic and gastrointestinal cancers. It's earned FDA Fast Track designations for pancreatic and breast cancer, as Oncolytics is pushing to bring this therapy to patients through smart clinical plans. Now, PaleoRep is a first of its kind therapy that makes cancer cells visible to the immune system. It multiplies inside tumors, causing them to burst while sparing healthy cells. It also turns cold tumors into hot ones, triggering immediate and long-lasting immune attacks. This dual action positions PaleoRep as a powerful partner for other cancer treatments. And cancer affects millions, with over 1.9 million new cases yearly per the American Cancer Society. Pancreatic and gastrointestinal cancers are especially deadly, with few effective treatments. PaleoRep targets these tough cancers, addressing urgent needs. Its broad potential taps into the growing cancer therapy. PaleoRep is advancing rapidly in pancreatic cancer through the Goblet Studies Cohort 5, a first-line metastatic trial. Enrollment is 40% complete and on track for full recruitment by the end of 2026 and is building on Cohort's one impressive 62 response rate. Enter an update including the overall survival data is expected here in Q1 2026, a key step toward registration. In gastrointestinal cancers like anal cancer, PaleoRep is delivering results. The Goblet study reported 33% response rate, including one complete response lasting over 15 months. And these outcomes show PaleoRep's potential to tackle hard-to-treat cancers. Trials are continuing to explore its impact. And like Ambrx, Oncolytics is an overnight success 20 years in the making. Proven science now gaining attention in immunotherapy. Ambrx started near a $50 million market cap before Johnson & Johnson bought it for over $2 billion. And Oncolytics sits at a similar spot: strong safety, solid efficacy, and platform potential targeting the RAS pathway, one of oncology's hottest areas. And while RevMed, an $8 billion valuation, and CG Oncology at $3 billion chase single targets, PaleoRep has broad potential across the $16 billion GI tumor market, pairing it with multiple therapies to reshape cancer treatment. And something that could reshape your trading account, well, that's the chart for Oncolytics Biotech. And you can find them on the NASDAQ and symbol ONCY. Now, if you are an Elliott Wave trader, check this out. Here's Wave 1. You get a pullback into Wave 2. Then there's a Wave 3, a pullback into Wave 4, finding support at a 6-month volume profile. That's the red line there, setting up for a monster move higher and breakout over $1.51. Now, Oncolytics Biotech is a leader in cancer innovation. PaleoRep's ability to destroy tumors and boost immunity is indeed unique. With the FDA Fast Track designations and promising clinical plans, Oncolytics is poised to make a big impact. The company is creating exciting possibilities for patients in biotech. Keep an eye on Oncolytics. Again, you can find them on the NASDAQ on the symbol ONCY. And as always, with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades, and use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.